Hi folks, myself Raj. Welcome to our channel Code Shack. Thanks to everyone for watching our podcast show. And today is episode number 26. Our discussion topic is the Fed trapped in inflation, national debt, and de-dollarization. So let's start our discussion. The idea that the Fed is trapped often refers to the Federal Reserve's challenging position in balancing multiple economic issues such as inflation, national debt, and de-dollarization. So let's first discuss about or let's break down of these challenges one by one. Here, challenges means inflation, national debt, and de-dollarization. So let's begin with inflation. We know the Federal Reserve aim to maintain price stability, often targeting an inflation rate around 2%. But in the last few years, we saw inflation ticking up and the Fed started a series of rate hikes. But inflation had been stubborn. But currently, we can see the inflation is slowly coming down. But extended period of high interest can slow down economic growth and can also lead to recession. As of today, according to the data, we can see the non-farm payrolls grew by just 114,000 during July, well below the estimate of 185,000. And the unemployment rate ticked higher from 4.10% to 4.30%, bringing into play something called sham rule. So, what is SAM rule? SAM rule states that the economy is in recession when the 3 month average of the jobless level is half a percentage point higher than the 12-month low. So, definitely the Fed is running behind the curve. As per data, we may somewhat land into a slight hard landing, but probably the time will say. Then comes the national debt. US national debt has been rising for years, but now it's at a record level. High debt level can constrain fiscal and monetary policies. As of now, high interest rate increase the cost of servicing national debt, leading to a larger budget deficit and eventually pushing into more borrowings. A large amount of debt requires significant portion of budget to be allocated to interest payment, and that reduces the funds available for other government function. But the Fed has the fear of geopolitical issues too, like the war in Middle East, which can push the crude oil price higher, and also the rate cuts with easing monetary policies can also push the prices higher. Overall, can cause the inflation to go higher. The fear remains for the Fed. And lastly, de-dollarization. What is de-dollarization? De-dollarization refers to the process where countries reduce their reliance on US dollar for international trades and reserves. The US dollar's status as the world's primary reserve currency gives the US a significant economic advantage, including lower borrowing costs. As of now, global situation is changing and major economies are trying to shift from US dollar, and it could weaken the dollar's value and increase inflationary pressure in the US. This may also cause the Fed to rethink before deciding for a rate cut. Overall, the Fed faces a trade off between controlling inflation and supporting economic growth. Tightening monetary policy to fight inflation resulted in a slow growth and increased unemployment. Generally, the Fed policies are influenced by global economic conditions. So, as per our opinion, the Fed position can be considered as trapped because it must navigate these complex and interrelated challenges without causing any negative repercussion in any one area. as balancing inflation control, debt management, and maintaining the dollar's global position requires careful and often difficult decision making. Now, the question is no longer whether the Fed will do a rate cut in September or not. But the question that comes up is how aggressive the rate cut will be. Will it be a 25 bps point rate cut or more? As always, the Fed has been late in understanding the inflation, and again, it's late in the rate cut. So, hopefully, they go into the right direction. Still, the economy looks strong, but we are moving towards a weaker territory. At this moment, the Fed is finding itself in the familiar territory of politics. In 1992, then President George H.W. Bush lost his re election bid and later attributed the loss in part to the former Fed chairman, I think Alan Greenspan, not lowering the rate fast enough. So also, I have seen many journalists and economists say the Fed does not want to change interest rate during a run up to an election. But historical evidence does not support much. As we can see in the 12 presidential elections, the Fed has shifted rates in all those years, but in the second half of the year. As of now, it seems that the economy may be facing some challenges and some weakness that might surprise Fed, and soft landing may turn into a little hard landing. That's everything for today. We want all our viewers to have a successful financial life. Hopefully, you guys like our today's podcast. Please keep watching our podcast show and keep sharing with your friends and family. We will try to bring in more financial topic that will help you to save money from borrowing and also keep you one step ahead from your lenders. Have a wonderful rest of your week. See you again in our next episode. Thank you.